Welcome and thanks for joining us here on Berman's Call. Here to take your questions on both stocks and ETFs. Here's how to reach us. You can call toll free at 1-855-326-6266 or email us a question, Berman's Call at bnnbloomberg.ca. Larry, good to see you.
Good to see you.
Gold attempting a bit of a recovery today. You had expected a correction, but do you expect a recovery after what happened on Friday?
You know, when we go back and look at other periods in history and we see the parabolic nature of what's occurred in gold in recent weeks, the downside could be measured correction-wise in months to years. There was a peak in gold around $1,900 in, I think it was 2011 or 12 timeframe, and it took more than a decade to recover to those highs. Now, I'm not saying that that's going to be the case this time. I think we can make a case for gold to continue to go higher, but we can easily correct. And if you look, if we were able to put some moving averages on there, you would see that the 200-day moving average is around 3,800 right now. And so I think we'll probably test that in the context of this correction phase, whether that takes a couple of months or longer, and that 200-day is rising. So, we probably come back to somewhere around 4,000, and maybe a little bit lower than that in the context of the next few months. And for those who have been waiting, looking to buy, I don't think today's the opportunity. I think you wait a little bit. And very, very possibly the highs that we saw last week are the highs that are going to be in place for the better part of the next year, maybe a bit longer.
How much of this was triggered by the announcement of a U.S. Fed chair nominee, or was it just a collection of things waiting to go?
Well, it's a bit of everything. Obviously, a lot of speculative activity, but I think Kevin Warsh was probably the best choice that President Trump could have made. So I think the market sourced some relief from at least part of the catalyst why people were running to the gold market. So, small box ticked. I'm not sure that we've solved the debt issue with nominating or the Fed balance sheet issue necessarily nominating Kevin Warsh. We'll see what changes come at the Fed. For the next couple of meetings, Powell's still there. We won't see any material shift in Fed thinking until we start, Warsh gets confirmed, first of all, and then we hear, some of his views, current views, not his historical views, because they've been very critical of the Fed and the way the Fed's operated. So I expect some change to come. And I think most of it will be positive.
We've got a long list of companies reporting earnings this week. Some started earlier, of course, in January. Which are you keeping a close eye on and why?
Well, Google and Amazon are the two, obviously, the big names. Google's had a phenomenal run up in the last year. It was a laggard for a number of years with antitrust concerns and others. And for the most part, they've skated by those risks to Google and really have focused on incorporating AI and really competing, on search. So what Google says is going to be really big, and what Amazon says, because what we heard from Microsoft on the cloud and Azure is part of why Microsoft's under pressure. If Amazon were to say the same thing, that could be very, very troubling for the broader markets.
Okay, what is your take so far on the companies that have reported? We did have Meta and Microsoft, as you mentioned, already reported. Is that setting a trend for the tech companies, you think?
Well, it's interesting. You throw Tesla into that mix, and they're right-sizing. They're phasing out, if they haven't started already, the S model and the X model, and focusing on the mass market and maybe consolidating Tesla with some of other Elon Musk brands, focusing on the future being robo-driving. Market didn't love it. So it's those kind of responses to me, Morella, that I think tell us a bit more about the speculative nature of the market and how much great news is priced in, that when a company doesn't say exactly what the market wants to hear, it gets punished a little bit.
Yeah, that's been going on. All right, let's take a quick break. We'll line up the first phone calls and emails for Larry Berman. Here again is the number. You can give us a call for questions on ETFs and large cap stocks. We're back in a moment. Welcome back. Let's go to an email from Scott to start. He says, hello, Larry. I'm retired, approaching 70 years of age. I manage my own investments. However, as I age, I want to devote less time to this. Also, my spouse has no interest in taking over in this regard should something happen to me. Would you recommend an ETF mix that would be more hands-off? I want a balanced portfolio, less emphasis on growth, more on income, and tax efficiency important as well. That's from John, I believe. There we go. Oh, sorry. No, that was
Yes.
Go ahead.
Yeah, so I think the email writer was Scott,
yes,
if I'm not
Scott.
mistaken.
Right.
But I saw this email come in, and I thought it was a fantastic question. And here's the challenge, Scott. You probably represent 50% of the BNN viewers out there, where you've watching it. One spouse or the other is very active, and the other one isn't capable, isn't willing, doesn't care to do the work necessary to be a do-it-yourself investor. And here you are at a stage in your life where you don't want to be doing it anymore. This would describe my wife and I, frankly. Like she has no interest at all in the investment side of it, and I do everything. What if something happens to me? And so it's a great question. And the Ontario securities regulators would have me hanging on a noose if I were to give you advice on what to do, because I don't know anything about your personal circumstances. And the question you're asking is excellent. And this is why at a certain stage in your life, and I know many people want to do it themselves, but you should find a trusted advisor, one that is a low-cost ETF-focused advisor, and for them to help you with this, because there probably will come a point in time when your spouse may need that if you're not around to do it anymore. And so these are great questions. I'm sure there's thousands of viewers out there with the exact same question. And rather than saying, hey, go buy these 3 or 5 ETFs and don't ever worry about it again, I would strongly recommend you find a trusted financial planner to work with to help you with this. And your wife should enter that situation.
Yeah, probably some good advice, because you're right. You'll probably want to go to somebody and get some information when that time comes. Let's go to a caller. John's on the line. He's in Toronto. Hi, John.
Hi, Marella. Hi, Larry. I'm looking for an Indian ETF. I noticed the Indian market had taken a little bit of a hit last week, I believe. And I was wondering if this would be a good time to get into an ETF. I'd like one that trades on the TSX if possible. Thank you.
Okay, thanks for the question. Is there an ETF, an Indian ETF that trades on the TSX?
BMO has one, interestingly enough, and there could be some others. Now, what is the ticker? That is a good question. Starts with a Z, BMO India, and I'm drawing a blank, unfortunately, off the top of my head.
Is it the BMO India Selection Equity Index? Does that sound right?
Yeah, ZID, I believe, is the ticker.
Yes, ZID, that's right.
Yeah, so that ETF's been around for a number of years. Now, I don't use it in my BMO funds because I'm a bit more active. And if you're going to trade it, the bid-ask spreads tend to be a little bit wide. If you're going to be a long-term buy and hold investor, it's more than adequate for your needs. In fact, last week, with the trade negotiations between the European Union and India, I actually doubled the position in India. I think it's one of the most compelling parts of emerging markets right now. So I really like this trade, ZID, if you want something that trades in Toronto. If you're looking for something that trades in New York, FLIN or INDA would be two really good ETFs that I use and would recommend.
Okay, John, I hope that helps you out, gives you some choices there. Let's go to Nazar. He's in Scarborough, Ontario. Hi, Nazar.
Hi, Marilla. Hi, Larry. May I have your thoughts on Brookfield Infrastructure Partners, please? It has a good dividend yield. With the increased spending on infrastructure by the Carney government, do you see good growth as well? Or would you prefer the parent, which is the Brookfield Corporation? Thanks for taking my call.
Okay, thank you for the question. We had this almost the exact same question on Market Call today about whether or not to invest in the parent company or the infrastructure play. What do you like?
I like both. I think Brookfield's one of the best private equity shops on the planet. And in the infrastructure space, it doesn't really matter what Canada's doing in infrastructure. Brookfield's a global player in the marketplace. So it's less about a Canadian budget, more about what's happening in the world. I think infrastructure investing is a good way to get additional yield into your portfolios. And so I like both a lot. Right now, I'd be more interested in Brookfield Infrastructure than I would at the parent level, only because I'm a little bit more concerned about broader market risk and some of these private equity type companies like KKR and Blackstone and Apollo not trading particularly well at the moment. So those are my current thoughts on the area.
Okay, let's move on to our next caller, Paul Teresia, I believe from Oakville. How are you?
Hi, Marilla. How are you doing?
Good, thanks.
Thanks for taking my call. Hi, Larry. I'm an avid listener of BNN. I've often, taken your advice remotely based on the feedback that you give to the listeners. Very prudent and very, it's well quantified and supported. I appreciate that. Today's question is primarily on, it's a two-pronged question. I've been investing heavily in ServiceNow. I use the Canadian hedged ticker for that. First of all, is that a good thing to do, or should I actually buy new stocks? That's one. Secondly, I have a very strong position in Salesforce, and I've been divesting from Salesforce to ServiceNow. I believe both corporations to be very strong in what they do, and they have a good product and a very strong consumer base. I wanted your thoughts on that. Is that a good, play, divesting from Salesforce based on where they are and the sentiment that they carry on in the market right now? And secondly, is ServiceNow a good investment, especially after they had a 1-to-5 split in the stock in December?
Okay. All right, let's turn that to Larry. Larry, software concerns, as you know, for the sell-off, but what do you think about ServiceNow?
Yeah, software overall is one sector that's been hit a lot, and it's thought of in the marketplace that artificial intelligence tools and agents are going to be replacing at the corporate level a lot of what software as a service kind of does for big business. So, I didn't like it a year ago when it was at $200, ServiceNow. I like it a lot more here. In fact, last week after earnings, and we saw a big gap down there, I started writing puts to start acquiring the name. CRM, I don't like at all. I think while it's historically been a well-run company, they're extremely hard to deal with. We fired them as a company a number of years ago because it was very difficult integrating and building it into our corporate structure. I know they still have many, many customers, but I don't love CRM at all. And I think there are other competitors there that are going to start eating their lunch for a much better fee, to the corporation. And again, AI agents are going to revolutionize, I believe, how CRM is done in the corporate world. So ServiceNow, again, better priced right now than it was a year ago. I'd look to accumulate, here and lower.
Okay, let's get to another caller then. Andreas is on the line from Calgary. Hi, Andreas.
Hello, Morella and Larry. Thank you very much to the both of you for taking my question. Larry, my question is about the iron ore sector and the companies there, and when that opportunity will be ripe again to invest in them. And I'm wondering about the company Cleveland Cliffs. I know that they may have are regarded as having a bit of a high debt level. What do you think about the investing in the company when the time comes again? I like your thoughts on that. I'm just going to hang up and listen to what you have to say. Thank you very much.
Okay, thank you for the question. Iron company here, Cleveland Cliffs, out of Cleveland. What do you think of them?
Yeah, these cyclical areas, I mean, you can go back, if we can put up a 5-year chart for get a little bit more perspective there. 5 years ago today, you've made no money, but it's gone up and down, quite a bit, for highs of around 30 a few years ago, lows close to $5 or $6. And right now, more in the middle of that range. So I don't love it at this level. Next dip below 10, maybe you accumulate it again. So it's a good name to own if you want to be a trader in the sector. But I got to emphasize, in a lot of these names in the big metals companies out there, you got to be a trader, not an investor, because these aren't growth stories. They're very, very cyclical. Unless you're getting compensated by a phenomenal dividend, in which case here you have none. You got to think about it from that perspective. And a lot of these mining companies don't pay great dividends.
Okay, let's squeeze in a last caller here. Ben is in Mitchell, Ontario. Hi, Ben.
Hello, guys. Thanks for taking my call. And I'm interested in my RIF. I have some U.S. funds there that I sold my stocks, and I'm looking for a dividend fund like Vanguard or iShares that have low MERs, and I'm just wondering what Larry thinks.
All right, so an ETF for his American fund, Larry.
Yeah, I mean, there's no shortage of styles and funds you can pick. They've got high dividend funds, which, weights based on the size of the dividend. There's a caution with those because sometimes the dividends will be unsustainable and you'll have dividend cuts. There are dividend aristocrats, meaning long-term consistent dividend payers. And then you've got, dividends with covered call overlays. So there's a number of different ways to play it. As a Canadian investor, if you're seeking foreign dividends, you've got the worst tax treatment. So are you in a taxable account or are you in a registered account? Most people seeking dividends are typically using them for current income, so they're in a taxable situation. And I love the idea of a foreign holding with a dividend covered call overlay. So BMO has a number of good ways to play those with a currency hedge, without a currency hedge. Have a look at the BMO website. ZW I think, is probably where you want to look.
Okay, let's leave it there for now. We will come back with Larry's educational segment. That's next.
Larry Berman is one of Canada's top technical analysts. He's the co-founder and chief investment officer of Q Wealth Partners. To learn more, visit qwealth.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN Bloomberg, its parent company, or affiliates.
Welcome back to Berman's Call. It is time for Larry's educational segment. Larry, I know you want to talk about private credit for fixed income. Why do you see it as a must?
Well, this week's educational segment's really inspired by a question that came last week, Morello, when someone asked me what are the most important things people should consider when looking at the private credit sector. Here's why it's a must. When we look at the historical performance of the public bond market and we compare it to inflation, you can see that the public versions of low-cost ETFs, passive fixed income investing in Canada, just aren't cutting it. So quick chart here we could put up. At the bottom there, we've got the Canadian CPI year over year rolling monthly over the last decade plus there. And then the total return of three different ETFs, XBB, the cumulative total Canadian bond market return, XCB, the corporate bond market, and XRB, the real return bond market. And when you look at those total returns and you annualize them, what you see after inflation is that you're not making the grade. You're putting your money in something and it's not growing, and in some cases not growing even enough to compensate for your purchasing power, your loss of purchasing power due to inflation. And so in the private credit space, you're getting compensated with yields that are typically 6, 7, 8%. There are many private credit funds that target 10, 11, 12%. But the risks are something that everyone needs to understand. So there's a group out there called CAIA, the Chartered Alternative Investment Analyst Association. And this is a way for professionals to get registered to look at alternatives. And you have to look at risk different ways. And so when you think about alternatives, they could be multi-strategy funds, market neutral, arbitrage, global macro. They have a different risk rating because the volatility of these type of privates, typically they're illiquid, and they might get only measured every quarter or every month, in some cases once a year. And so just looking at the volatility isn't enough. But when it comes to private credit, let's look at the next slide here. When you think about what you're investing in, so senior secured, the low to medium risk, the equivalent of a good corporate bond fund, XCB, for example, in terms of its risk rating. This is something that's going to give you a payout 6, 7, 8% kind of range with low to medium risk that fits for most fixed income investors. So you have to understand that they're illiquid. You may not be able to get your money out when you need to. So if you have 40% of your portfolio in fixed income, in any given year, let's say you need 5% to live off of. Keep that in something liquid like a low-cost ETF. But put the rest or longer-term money in something that's going to give you a better return after inflation without taking significantly more risk. When you look at the report that TIA put out, TIA is one of the largest pension managers in the U.S. that's responsible for the teachers network across the U.S., and they do a survey every year. So I put a link in the blog today about this. I encourage people to go have a read. But the reality is more and more pension funds, as they think about, solving that, non-working period of your life, are going into private credit. It's only increasing, nothing to be worried about, but really try to understand the risks as they pertain to your needs.
Larry, got to leave it there. And thank you for joining us today. The close coming up next.